not even showing 7.5. I'm having a hard time understanding why we need to prop up these failed banks because of their derivatives and their malinvestment. Why is it that they get to go to the discount window and the people that work so hard, they have to borrow money from them at a higher expensive rate?
Yeah. Okay.
Why can't
Well,
they?
first of all, I think I agree with much of your thought about propping up banks. That is, that we need a system in which banks are going to fail if they make bad investments.
Not if you keep propping them up with cheap credit.
So I'll let you finish your question, and you can let me finish my answer. Okay.
Oh,
You're all done?
yeah,
Okay.
go ahead.
All right. So the sentiment behind your thought, I think, is right on. Which, if banks make bad investments, they have to be free to fail. Now, so what happened under the Bush administration that created the circumstances that couldn't happen? Well, first what happened is mortgages were regulated so that predatory mortgages that had a 2-year teaser rate, prepayment penalties so families couldn't get out of it, so it's like steel jaws clamped on them. And then these were sold with steering payments, which were undisclosed bonuses paid to the loan originators for steering people from the prime loans they qualified for into the subprime loans that had these terrible provisions. Then Wall Street took and packaged those loans and put them into securities and sold them throughout the financial world. When the bad loans went bad, the securities went bad, and the whole economy blew up. But one reason one might ask, well, why did people buy these securities? First, they were AAA rated often. Second is there was a new product that was allowed by deregulation, which was called swaps. Now you can think of a swap as a bet, and in this case a bet on whether a security would go bad. And these swaps were sold by AIG in a way that tied together financial institutions throughout this nation. Now I wasn't there when all this was happening, but I can tell you that these developments at the retail level and at the Wall Street level created a house of cards. And that house of cards came tumbling down. The intervention that what the response was a complete collapse that would drive us into a Great Depression. But that was the emergency response. The second response was, how do we redesign the banking system so this can't happen again? So the first is to take on the retail predatory practices. And I took on ending the liar loans, ending the prepayment penalties, and ending the steering payments, those undisclosed bonuses to steer people into subprimes. And I got all three of those passed last year to reform our retail mortgages.
At the process of auditing the Federal Reserve.
Why you rob up the banks, though?
And then
You reward them for their crimes.
And then I took on Wall Street with something known as the Volcker Rule. Volcker is the modern Glass-Steagall Act to erect boundaries. And nobody thought this act had any chance of passing. What I was proposing is strong rules that do three things. They say that commercial banks cannot do proprietary trading. That's for investment houses and hedge funds if they want to do that outside the banking system. The banking system is there to provide loans to families and businesses. And the second is that non-commercial bank investment houses, as they become large enough to become systemically significant, such that people are afraid to let them fail, they have to have much higher capital requirements so that their growth is discouraged and their odds of failing are lower, because we have to have a situation where there's accountability to these institutions. They make mistakes, they can fail, without taking the entire country into the hole with them. And the third was to end what Goldman Sachs was doing, which was packaging these loans, these bad loans, selling them, knowing that they were going to go bad, and then Goldman Sachs took out insurance on them, so that when the loans went bad, people would make money. So it's kind of like selling something to you, but I know it's bad, and I make a bet it's going to go bad, and so not only does my customer lose when it goes bad, but I profit. And if you can think about it like this, it's like an electrician wiring your house, and then that electrician taking out a fire policy on your house. That would worry me if my electrician took out a fire policy, and it should worry all of us. And so those three things were packaged into the Merkley-Levin amendment. The Volcker Rule, the higher capital requirements, and the end of the conflict of interest. And I think I can safely say that nobody thought this could be passed. And essentially, through a long battle that involved losing in committee, losing on the floor of the Senate, even though I had the votes, because I couldn't get the amendment up without unanimous consent. The Republican leader would not allow the amendment to come up, but then won in the conference committee. And so those things did become law last year. That isn't the entire set of reforms that have to happen. There's a lot that has to be done. I can tell you one key piece was the Consumer Financial Protection Bureau, which I'm very pleased made it through